just to get to know each other, I am Chirag Mehta, the Chief Investment Officer at Quantum Mutual Fund. How many of us here are Quantum Mutual Fund investors? Okay. So, and how many of you all invest in mutual funds? So everyone. Okay. Great. So today we are staring at a backdrop when equity markets are falling and investors are kind of confused where to allocate. I think long-term investors or the thoughtful investors are not worried because they are very well allocated to different asset classes, and that's so not a big point of worry. But there are a set of investors who kind of have not seen such falls before. If you look at the run from 2015 or 2014, the falls have been very, very small or very, very low duration falls that we have seen. Even the COVID fall lasted for just about 1 or 2 months. Post that we saw a good recovery in markets. But this time we are seeing at the economic conditions in India as well as globally, which are kind of changing things around. So we look at those data points and what does that tell you and how you navigate your investments in these times. So there is uncertainty, there is no doubt about it. What is leading to that uncertainty is inflation. Inflation has been rising not only in India but globally. If you look at, there has been so much money being printed by central banks because COVID hit economies hard, and as they usually react, they started pumping in a lot of money in the markets, and that is what led to a lot of money being printed. So even if you look at US central bank, they were at 4.5 trillion balance sheet. They increased or doubled their balance sheets to almost $9 trillion. So we have seen a lot of money being printed by US, by Europe. And today, given that, earlier people used to say that, inflation is transitory, it's caused because disruptions because of COVID and supply side constraints are leading to that inflation. But it's no longer that. Inflation is very, very entrenched. And if you look at the food prices increasing, that is also leading to global commodity prices increasing overall. So inflation is there. It's a very high level of inflation and will continue to remain for some more time. We will see why. That is leading or forcing the central banks across the world to increase interest rates. Though much of it is supply side, but still they will have to give savers a real option in terms of giving them interest rates to compensate for the high inflation that is there. Also, to soften the demand so that there is some equilibrium and prices start falling. So they will have to increase rates going forward in India, US, elsewhere also. What we have seen, typically that we have seen across cycles, whenever there is an increase in interest rates, usually there is an outflow by foreign investors, and this time is no different. And inflation, because of raw materials that companies consume, the prices of those raw materials are increasing, which is leading to some decline in profitability. So people said earlier, the increase since March was because of COVID, but if you see even this year, there has been significant, because economies have normalized now, still we are seeing increase in inflation, and that tells you that inflation was not transitory, it was very well getting entrenched. What is the difference, why we are seeing inflation this time, and why we didn't see after 2008? When they printed a lot of money after 2008 global financial crisis, that money remained in financial circles, didn't seep into the real economy. This time, when COVID happened, they did a lot of handouts to people and money trickled down to the bottom of the economy. And when money goes down to the economy, in the hands of people, people go out and spend that money. And that is why we are seeing inflation, and inflation will likely remain with us for some more time. So people said that after 2008 crisis they were printing a lot of money and everyone was expecting inflation. Didn't happen. Similar will happen this time, but no, this time is different. This time money went down and everyone spent it, right? If you see, people in the US got hard cash in their accounts so that they could survive the COVID period, and the economy will recover because of that. And that is what is causing inflation, because those people went out and spent that money. So inflation is no more transitory, it's very well entrenched across the world, and we will see that inflation continue to remain with us for some more time. So inflation, this is India. We are talking about India. Inflation is well above RBI's comfort level of 6%. And now RBI is starting to react. They are starting to increase interest rates. And if you look at where the major inflation has come from, is these areas: food and beverages, clothing and footwear, fuel and light, household goods and services, and transport and communication. The red circles you see, we anticipate that there will be more inflation in these points because the fuel and light, if you see, electricity prices have not gone up, their input costs have gone up. Second is kerosene prices have not gone up. So all that will lead to continuing high inflation in fuel and light. Household goods and services, the goods that we commonly buy, the prices of those goods have not gone enough. Companies have started to pass it on, but not happened fully. So you will see inflation persisting in household goods and services as companies pass on the cost to consumers like us. And transport and communication, because of oil prices increasing, you will see increase in transport cost as well. Also communication, because all the towers that you see run on diesel gensets, and therefore the diesel cost going up will also lead to communication cost going up. So overall, these three pain points will continue to linger with us for some more time, keeping inflation high. And therefore, the RBI will be forced to rate hikes further. Currently, we are at 4.4%. We will see at least 5.5 very soon in next 2-3 RBI meetings, because 5.5 is a level that was prevailing pre-pandemic, and therefore immediately to remove that accommodation of COVID, they will increase rates to at least 5.15%, and eventually even more if inflation continues to remain high. So they could go from anywhere between 5.5 to 6% is our estimate, where the RBI will increase interest rates to.
Chirag,
Yeah.
Can you go to the previous slide?
Sure.
Have a small bit.
This one?
Yeah.
Yeah.
What is this 249%, 268%?
Since the COVID lows, the price increase of crude oil is 249%. And coal is 268% since March 15, 2020, which was a COVID low. Since that time, we have seen such increases in commodities prices.
Since 15th March till now.
Till now.
Till now.
Till April, yeah. So coming to inflation, again, what we have seen is inflation is very broad-based, and it is impacting the world more than it is impacting India. And the reason for that is the food prices. India is self-sufficient in food. So far, that's not been a problem for India. But for world, it has been a problem. If you look at wheat prices, they've gone through the roof, right? And most countries are not self-sufficient like India is in these food prices. So India has its own price, whereas those economies go on whatever is the global prices. And therefore, India is given self-sufficient in food. It has not been a problem. But if we have a bad monsoon, then again it will be a problem for us. But otherwise, we should be fairly reasonably okay as far as the inflation is concerned, given food prices is not a concern for us much.
Our main concern is the crude oil.
Main concern is crude oil. Crude oil has very big impact on our economy. Firstly, we need dollars to pay for our oil, because much of our oil is imported. We don't produce any oil in India, barring ONGC production, which is very, very little as compared to our consumption. But overall, crude, if it goes to 140, 150, we will have a terrible time in India.
There is a fertilizer shortage also, isn't there?
There is fertilizer shortage because of rising gas prices. Gas prices have gone up significantly higher, which is causing those fertilizer prices to go up. So India, if you look at inflation in US, look at the long term. Since 2012, this is a 10-year data. Until now, it was very low, between 0 to 3%, right? Look at the level now, it's closer to 9% level in the US. Whereas if you look at India, from an historical perspective, we have seen such inflation cycles before. It's not new for us. We have been through these cycles, our companies have been through these cycles, our consumers have been through these cycles. And if you look at our inflation has been inching higher, but not as high as what we see in US. The main difference being food prices. Food prices are not impacting us much, and therefore our inflation levels are not as high as what we see in the US. So this tells us that US Fed, US Central Bank will have to be more aggressive in increasing interest rates as compared to India, which may not have to be so aggressive because our inflation is still not as high as what we are looking at in the US. So someone will say that US will do a 150 basis points hike, India may not have to do so much. Now that's inflation, which we all know is a problem, but India is a least dirty shirt out there, right? So India is not in a very terrible situation as many other economies are. So that's given. Now, what are the levers of growth? Inflation aside, crude being a problem. Otherwise, how are we seeing the economy move up? Right? We think that India was on a cusp of an economic revival, and it will continue to be, or looking at that cyclical recovery to continue. And there are certain levers or reasons why. It's been pushed back because of inflation, because of consumer spending getting a little bit impacted because of inflation. But that story is not over. The cyclical recovery that we were seeing in Indian markets, it's not over as yet. We will see that continue, maybe a bit delayed. So why are we saying that? If you look at residential market in India, or real estate sector in India, is coming out of doldrums. We have seen 7-8 years of bad cycle in real estate. Now we are seeing activity pick up. Why? Because affordability from a real estate perspective is as good as what we were seeing in 2002, 2003. In last 20 years, it's been one of the areas which has seen improvement because the income to EMI ratio is standing at where we were in 2002, 2003, which was again a start of the real estate boom that we saw. Will we see that boom? It's too early to say, but activity will continue to see increase on that side. If you look at inventory, is been falling, is low, is trending down. Sales have been picking up, and this is because incomes have remained or continued to increase, whereas EMI or interest rates have been lower, and that has helped real estate market in India. Second lever, you all are in Bangalore, you all would know better than us, but IT sector has been booming. If you see, IT hiring has been significantly large than what we have seen in previous 10 years. So IT sector, which is leading to job creation and high paying jobs, is what is helping the recovery as well. So this is one of the important levers that we are seeing in Indian economy. So residential, IT, and the third lever that we are seeing is government spending. Government spending, government has announced a big capex program, and that will lead, or they are front loading that, or trying to revive the capital expenditure spending in the economy. Also, we are seeing that if you look at capex from companies, also certain companies, because of PLI, because of other reasons, have started to increase or incrementally announce more capex. If you look at capex plus the IT spending, so IT spending by companies is usually not taken as capex, it is considered an expense of those companies. And if you include both, we are currently at 30 to 32% of GDP as capital expenditure, which at the peak was at 35%. So capital expenditure has been increasing. That is also leading to that recovery that we are seeing in the economy. So India, according to us, is very well poised for that cyclical recovery. Inflation, rising interest rates could be a dampener. Falling equity markets could be a dampener from a notional wealth perspective, because everyone, if equity markets are high, everyone thinks that notionally they are making a lot of wealth, and therefore their spending kind of increases during that period. So there could be few dampeners which can delay the recovery, but we are very well entrenched into a good recovery cycle, which we think will continue. Yeah.
So the capex is only in two sectors, which is real estate and IT, as you mentioned, 32%. Rest of the sectors, there are no capex happening in the capital goods sector.
No, there are certain companies who are announcing capex because, for example, in the automobile sector, EV expansion or EV production, or EV lines, etc. So there are certain, because of the PLI thing, there is a lot of capex likely to come more. Also, there is one thing. If you look at the global companies, because of the problems what they have seen in China, and if you look at last 2 months, China has gone through a phases of lockdowns in major cities, which is reinforcing the thought of China plus one. So China.
Are we hearing that from past 3 to 4 years now?
No, China plus one has been like 2-year phenomenon, largely, which is accelerated because of COVID and because of the crackdown that we're seeing in China. Global companies are looking at that thought process, but committing that large capital takes some time. So we will see that China plus one also playing out, PLI playing out, government capex playing out. But so it's not only real estate and IT leading to that capex. There are many industries who are trying to expand further. So if you look at cement, there are many companies who announced capex or increasing. It's not greenfield, it's brownfield. Existing capacity they are trying to enhance. But there is small amount of capex that we're seeing. It's not significantly large, but it is growing. Plus IT spending of many companies, AI, etc. Getting on the CRM, etc., is increasing significantly. So we are seeing that capex. It's not termed as capex, but it's IT spending increasing as well.
Why do you think there is a kind of a downturn in pharma sector?
Downturn in pharma. So we'll take those questions at the end if you don't mind. We'll just go through the flow, and we'll take all your questions at the end. So even what is helping also GST collections, direct tax, indirect tax, etc. are increasing, which will give leeway at some point in time for the government to increase their capex. They already announced big capex. So from a financial fiscal deficit perspective, it may not be an issue given the increase in GST collections that government has seen. Few trends that we are seeing in the economy is because of demonetization, because of GST, because of COVID, the larger companies are getting larger that we are seeing in the economy. If you look at the sales growth of top 30% of the companies versus bottom 30, sales growth has been much better for the top 30% of companies versus the bottom, which is also evident in terms of larger companies getting larger. Also, the fixed asset growth for larger companies has been more robust as compared to the bottom 30. If you all have heard us before COVID, when we came here and we were talking about our view on equity markets, we were kind of more bearish on equity markets at that point in time because we were not seeing earnings growth in the economy, right? Everyone was more hopeful that earnings growth will come, economy will move on an upswing. But if you look at revenues of companies, or be it the profitabilities of companies, the orange and grey lines are profitability indicators, and the blue line is the sales growth of companies. From 2015 till 2019-20, it was very, very muted. Slight increase, profitability staying flat. There was not much activity on the ground. And that is where we were kind of a little bearish on equity markets because everyone was very hopeful. Everyone was ready to pay a high price because of that hope. And markets were moving higher, right? But activity on the ground was not there. But now if you see, activity on the ground is picking up. If you look at revenues of companies, if you look at profitability, has been increasing. This is where we are getting more bullish on markets because we are seeing real activity happen, which is translating to higher revenues and higher profits of companies. So this, I'm sure many would be familiar because if you've heard us before, when Modi government came to power, everyone was very hopeful on earnings growth pick up in the economy. But if you look at earnings, the sell side, the brokers were saying that, the earnings because of the single party mandate that has come to BJP, there will be reforms, there will be growth in the economy, and therefore there will be higher revenues and higher earnings of companies. What happened? 2014, it was lower than where estimates they started the year with. It didn't come this year. They said it will be next year when earnings growth will be better. when they started with a higher earnings growth number and it came lower. Again, they said it's not come this year, it will come next year. So they started next year with a very high earnings growth number and it came below this year. Similarly, in FY17, FY18, FY19. So there has been no earnings growth, and that is what we track very closely, and that is where we didn't have that confidence in equity markets then. But now, we think that actual earnings may continue to surprise what people are expecting because of the recovery that we are seeing in the economy. So now we are getting slightly more bullish because of this earnings growth that we are seeing, real earnings growth translate for companies that we are seeing in the economy. So overall, we will see that earnings growth will continue and upgrades will continue for companies. It may get delayed by a year or so because of inflation and cost pressures that companies are facing, which will lead to delay once commodity cycle or inflation normalizes, and when we see that companies are passing on some of the increases over to consumers, that is where it will again start translating into further higher earnings growth. So this phase we were not so gung-ho on markets, but now we are kind of gung-ho on markets. This is the PE, price earnings ratio. This tells you that for every earnings of the company, how much multiple you are paying to buy that earnings, right? So if you look at a long-term average, which used to be around 17, 18 times, because of this phase that we have seen of high PE, it has moved to 19.7 as an average. But if you look at this has been falling. You should ignore this, because in this phase, because of COVID, there were no revenues for companies, there were no earnings for companies, and therefore this isn't the right number to look at. But overall, we are getting closer to the average. If some more fall in markets, we will be very close to the average levels. At bottom of market, we have seen like 10, 12 times PE on a historical basis. But given high earnings growth, even if it comes closer to the average or slightly below that, I think you should be buying that into. So because of increasing interest rates elsewhere, because of the strengthening of the dollar, we have seen some capital fly away from our economy, which we have seen before. Even earlier tightening cycles, we have seen money moving out, and this time is no different. There was a lot of money that came in 1920, and that has seen good gains because of the run-up that we saw in equity markets, and therefore there is some profit booking happening from these foreign investors. From a valuation standpoint, India, as compared to other emerging market economies, was very overvalued. India had seen huge run-up in equity prices, other markets had not, and naturally, India was looking overvalued, and some capital is now moving out of our economy, our markets, into other markets, right? So we have seen $16 billion of outflow, but at the same time, domestic investors like all of us have put money in equity markets, significantly large over last 2 years. In 21, we put $10 billion, and 22 so far we have already put close to $12 billion, right? Just see the difference. In 2008, when FIs withdraw close to $12 billion, Indian investors were not a big addition to market, and markets fell by 60%. But now, when we are seeing good flows by Indian investors and foreign investors pulling out more than what they did in 2008, our market is only down by 4.5%. So that is a great force that we are seeing counter to the FI flows. Earlier, what FI did, they told us where markets will move. It's no longer the case. So we are seeing a good recovery. We are hopeful of recovery in markets. What could go wrong? If inflation continues to persist, if oil goes up higher to $140, $150 and stays there, it's clear a problem for India. So,
Sorry, excuse me, what goes up, you said?
Oil prices,
Oh, oil.
crude oil prices goes to $140, $150, it will be a problem for India for sure. Especially for small and medium enterprises. rising inflation is a big problem because their input cost increases. A. Second, given they are smaller companies, they don't have that franchise, and therefore it is difficult for them to pass on that price increases to consumers. Larger companies who have that franchise, who have that following, who have that loyalty, will be able to pass on to consumers. So the trend that we saw of large companies getting larger may continue to persist in a high inflation environment. Also, if you look at consumer discretionary spending may also decline if inflation continues to persist, and what they will not look at is these smaller companies, right? Goods or services from these smaller companies. Also, if there is an extended war, and God forbid if we have a bad monsoon, then it could be a big problem because it will not only impact supplies, the cost of supplies, but also the supply chain will kind of disrupt, and we will not. If you look at car companies, they're already bracing through a storm because of semiconductor or chip shortages that they are seeing, right? It is impacting their production. Demand is weak currently, that's a different story, but still they are seeing that production being impacted. Even if demand revives, they will be finding it difficult. Yeah.
So what I read in between lines from what you're just saying is,
Yeah.
large cap is much better than small cap?
Yes.
Okay.
Yes. In this environment, at least, large cap is better than small caps.
This disrupting supply chain, what you have put as the second point.
Yes.
We see that there is an advantage there because, the entire supply chain is getting, recalibrated. So,
Yeah, but until it kind of settles down, it still will be a problem for production.
but they see a great advantage to India and.
It could be,
Other,
provided we have good policy making that is kind of committed to what they offer investors, foreign investors, and they have to rely on that commitment. We have seen flip-flops in the past which have led to for these companies moving out. For example, take Holcim. Holcim is leaving India. Why? They are in the cement business. ACC Ambuja are one of the finest companies they have in their portfolio. They are much efficient. They are much better even than their European counterparts. Still, they are moving out of India, right? So we need to have serious policy making, look at these issues, and see why these bigger groups are kind of moving out of India.
You just mentioned 2 points, Chirag. One is the oil prices going up, which
Yes.
is not good. The second one is also, on similar lines, or is it monsoon?
Monsoon.
Okay.
Monsoon and the war. If
And
kind of.
okay, and just to add to that, does even dollar impact dollar going up? Dollar prices going up. The
Dollar prices
the power to
going-
buy dollar is now 77.80.
Yes, so it does impact it to some extent because our oil or commodity import will be that much more expensive. So it does impact, but at the same time it also helps our exports. It makes our exports a little more competitive. So it does help us to some extent. So it will kind of adjust, but a weaker dollar is bad for us.
But the balance is always, our imports are more than exports.
Yes,
So it affects
it affects us more, yes. So again, weaker than expected monsoon is again a big risk that we could have, given that inflation, 49% of our inflation basket is food. So if food gets hampered, then again inflation will be higher and RBI will be forced, though it will not have an impact on supplies, but still they will be forced to increase interest rates.
But this year they say, IMD says we will have a good monsoon.
We will have a good monsoon, but if you look at the climatic conditions are changing significantly over the last few years. Heat waves in India, which were not so prevalent, this was the hottest year in last 122 years. So it will have an impact. It's kind of becoming more unpredictable in a way because of the changing climatic conditions that we're seeing. And that's because of global warming.
In Bangalore is probably not going to wind chill in
Yeah.
the past years.
Yeah,
Bangalore
yeah.
is cooler now.
Cooler, exactly. So everywhere it's changing. And if you look at the new IPCC report that says that India will be more impacted now than many other global nations because of global warming. Based on where we are located on the world map, we will be more impacted because of the climatic changes.
So what is the more likely that crude oil prices will in each of around 140, 150? Is it a direct impact of the war, because of which the supply chain has reduced. That's
So
second
we
thing.
don't know
And
till
second
what
thing is,
time.
The OPEC countries have, reduced their,
Correct.
production. So as the war, probably if the war closes out, then probably the crude may fall down to around 90s.
If war cools down, we don't know that.
Yeah, so it is a direct.
So we are not saying
correlation.
that, but we are citing it as a risk.
But isn't it a correlation between two factors? I mean, it is not a separate in itself. It's as war stops, probably if the war.
No, even if the war stops, Russia supplies may not come on stream. Europe is saying that we will not want to buy any of the energy supplies from Russia.
See, it's a dynamic relationship because.
It is very, very unpredictable, and that is why we are not saying it's certain, we are citing it just as a risk.
Because see, European Union, like Great Britain, they wanted to buy Russian crude now.
Correct.
Even after.
Even US is still buying, despite doing telling so many things
we cannot
about
say,
it.
Russia will not be able to sell it.
No, Russia will be able to sell. Like for example, India has been a buyer.
And second thing which you mentioned about wholesale, they had an all different, it's not because of the policy making, they had their own problems because of which they are going out. They could not sustain the competition in the market, in current Indian market, because realizations were less. Second thing, they could not face that competition with the other companies.
ACC, Abuja were all profitable companies, and if you look at cement prices, be it any company, they all move in sync, right? There is allegations of a big cartel going out in the cement manufacturers. So we don't know. So I mean, given that both were profitable since a long time, and given that there was no disanomaly in prices that we saw in cement markets, it's difficult to say that they are going out because of competition.
No, but not because of the policy also. I would say.
No, we don't know, right? I mean, we'll have to talk to Holcim. Today they are saying that they just want to exit out of it. They are not giving any concrete reasons why they are going out of it.
Chirag, just to add, you are right. Actually, it is because of policy. From whatever I read is, there is a cap that you can take only like $10 billion out of the country. So already the valuations of ACC and Ambuja had reached that level.
10 billion.
Yeah, so you are right. It's because of the policy. So beyond that, they can't take the money. They might as well give it and go.
Correct.
As well as the green initiatives, they don't want to be in cement industry because of the green.
They are not exiting our cement businesses out of Europe, right? Yes,
Maybe the
still
green
there.
credits are exceeding. Anyway, you are right, policy.
Yeah, but if you look at Indian laws, they are not as stringent as where Europe is growing. If they really want to, get out that greenification thing, they'll get out of European assets than Indian assets.
Absolutely.
So all said and done, people will come and tell you that India will grow at 8, 9, 10%. Don't buy that argument. We'll have one-off years of 8, 9, 10%, but India sustainably cannot grow at 8, 9, 10%. We don't have that infrastructure, we don't have that capital to be able to grow at that 8, 9, 10%. India has billion people, India does not have billion consumers, right? So given that fact, given where our savings rate is, given the consumption ability of the economy, we will continue to grow at 6.5% real GDP growth for next 10, 20 years. So buy this story. Don't buy that 8, 9, 10% story. This, despite what we have seen across since 1980s, 40 years we have seen that India grow at 6.5% real GDP growth rate. Despite different governments, single party, coalition governments, despite war, famines, assassinations, etc., we have grown at 6.1, 6.2% real GDP. And we think going forward, India will continue to grow at 6.5% real GDP growth rate for next 20 years. So buy into this story. If you look at what stock market should do, it should reflect earnings of companies. The prices of stocks should, at the end of the day, reflect earnings, what company is making as profits. And if you look at the estimates, we are currently at around this level, 1433 in terms of earnings. They will increase to 1696 and 1890 over next 2 years. Right? This is as per the estimates by sell side. And this time we are not saying that it may not happen. There's larger or high likelihood that this may happen, or it may even surpass this.
Will earning growth be twice as much as GDP is a fair estimate? So if GDP is 6, then the earning growth should be 12?
Yeah,
Minimum?
I'll come to that math.
Oh, okay.
I'll give you that math. So based on where earnings growth are projected, based on the long-term average of multiple that India has, the Sensex level by end of 23 should be closer to 60,000. This is nothing but what is the estimates of sell side on earnings of companies, which we believe can happen based on the long-term average multiple that India has. Sensex should be at around 60,000 by end of 23. So coming to the story, what kind of returns should you expect from equity markets in India, right? It's a very simple math. India on a real basis will grow at 6.5% real GDP growth rate. Inflation in India will be around 5.5%. So let's take 5% lower end. So if you add both, India on a nominal basis will increase at around 11.5%. If the economy is growing at 11.5%, the revenues of companies will at least grow in line with the economic growth, right? So average of companies' revenue increases will be at least 11.5%. Assuming revenues equal to profitability, usually it is more because companies become more efficient over time and therefore profits grow larger than revenue growth. But assuming it grows in line with the revenue growth, so if revenues are growing at 11.5%, profit grows at 11.5%. Companies which are larger, as we saw larger getting larger, larger companies are typically more efficient, and therefore if they are large companies, part of the indexes, etc., they'll grow at 13.5%. If you are able to pick better companies out of this lot, you should have an alpha of at least about 1.5%. So typical good portfolio should grow at about 15% per annum. And this is not different than what you saw growth from 1980s, 1990s till now, right? That math is not changing. This math is not changing. So if you are an Indian equity investor, invest over 10, 20 years, you will reap this kind of returns. And we'll show you more data why this can happen and why this has happened. And we believe that currency will continue to depreciate by about 2% per annum. So far it has depreciated over long term by 3.5%, 4%. It will continue to depreciate still at least by about 2% per annum. So people try to time the market, right? They want to maximize their returns and therefore they try to get a better entry point. That's good. But even if you invest at an average, do an SIP, still your returns, long-term returns are good enough. If you invest at top of markets usually, then your returns go down. And if you invest at minimum, at the lower end of the point, your returns are much better. But still, this is not a bad return. 13% is good enough return even if you average out your cost over a period of time. This tells you that, it could be good to, time the market, but still if you kind of continuously invest in markets, still it is good enough return for you. And the longer you invest, the better your chances are of not making a negative return and making a better return. So if you look at a 10-year period, your average rolling return on any 10-year period will be closer to 15% on an average basis. If you are investing, this is since 1996, this data is since 1996, and each return in this 189 data points is a 10-year return. And the average of that is 15%. On a 10-year basis, any 10-year period, minimum you would have got close to 7% and maximum you got close to 22%. Even on 7 years, it's 14%, 15%. On a 5-year basis, average is 14%. So longer you invest, your returns from a point to point, any point to point, is decent enough on an average. So have long-term horizons and you minimize negative returns. On a 7-year, markets have never given a negative return. On a 10-year, markets have never given a negative return. Right? And chances of you earning better than at least a saving bank account, which is 4%, for example, this is 6.8 on a minimum period. So invest for a long term, you will see that you will not regret that decision.
So what is the second number of cycle is what exactly?
So since 1996 till now, so a 1 year period for an investment from August 1996 will be from August 1996 to July 1996. So that's a 1 year period. So your 1 year starts from July 1997, sorry, and from so that becomes a 1 year period. Similarly, if you keep calculating or keep going 1 month ahead, you will have seen 241 time periods or 1 year returns. So longer you invest, you will have better outcome and reasonably good returns. So don't invest in equities for 2, 3, 4 years. It should be at least minimum of 5, 7, 10 years of investment in equities if you are coming to equities. Then only you will reap the real benefits of equity investing. Given equities are great asset, should you put all your money in equities? No. Definitely not, right? So we think that there is a formula. People keep asking us that how should I invest? How should I decide where it should? If the money is long term, if it is for long term wealth creation, if you don't need that money for 10, 15 years, then this formula of 12, 20, 80 works really well. Be it any time period, be it the global financial crisis, be it the COVID crisis, or be it any other outcome that we have seen, this has delivered better returns for investors. What we mean by 12, 80, 20 is 12 months of very safe money. Whatever you think is the safest place, be there. Be it a bank fixed deposit, be it a liquid fund that does not take credit risk, like the quantum liquid fund, we don't take any credit risk in that. So anything that you think is safe, you should invest that 12 months money. If you are conservative, that 12 can become 24, can become 36, but that money, you should keep it very, very safe. In case there is a period like COVID where there were job losses, if there is a business income loss, etc., then that money is used, right? Otherwise, it has not to be touched. Rest of the money, after you keep that safe money, rest of the money divide 80% into equities and 20% into gold. Why gold? Because whenever equity markets have fallen, gold generally does well, right? So it is a kind of a hedge for your portfolio. Like we all buy insurance, right? We don't hope that we don't go home safely. Nothing should happen to us, but still we buy insurance in case something happens. So in case your portfolio goes through losses, gold is the asset that will help you. So break your assets 80 into equities, 20 into gold, and that 80%, which is the big chunk, has to be diversified across styles. What we have seen, there is a lot of inconsistency in performance even from fund managers. There are different styles through which fund managers invest, and every style goes through a cycle. For example, last 4 years were bad for value. From 2017 to 2020 were bad for value. Maybe in the rising interest rate scenario that we're getting into, we may see that growth managers go through a bad cycle, right? So diversify across different styles of management, and this could happen from within the quantum family itself. Quantum equity fund of funds which invest in other managers, tries and identify good managers for you which are consistent. You could have about 70% in that, and 15% in a value style, and in sustainability investment is what we recommend. 20% of course in a gold ETF or a gold fund will be desirable because they are very, very liquid. If you have to rebalance your portfolio, you can do it easily.
May I just ask you, what's the return of the quantum liquid fund?
Quantum liquid fund since inception has been around 6.5% to 7%, somewhere in between that. But given interest rates were very low for last 1-2 years, it's been less than 4%.
Yeah, that's what it's dipping.
Now it will start increasing, given we are seeing increasing interest rates by central bank. So the repo rates, meaning the cost of short-term money is going up also, and the longer term has already gone up. So we will see that now returns keep increasing, given we are in a different rate cycle now. Earlier we were in a falling rate cycle, now we are in the opposite rate cycle. And to play this cycle until we reach the peak of increase in interest rates is to play the liquid fund rather than being in the bond fund.
That's in money market?
Money market. So shorter end will see lesser impact because of rising interest rates, and therefore, and each deployment will keep happening at a higher rate.
See, while you told like gold is a hedge, but then in a scenario where you have bond rates also, like yield curve is also going up and equity is falling,
Yeah.
then gold may not be the right hedge. Gold will
Yeah,
still not go.
I'll come to that view on gold. I have a slide, couple of slides on that, where we'll give you our view on gold.
Yeah, what about the return on fund of funds, like over several cycles? Like if you take multiple cycles of 5 years,
Yeah.
then what is your average of fund of funds?
So I have a slide on, I'll show you that return.
Okay.
Long-term return has been around 14%. Since 2009 till now, the CAGR return has been close to 14%.
What is the play money?
Sorry?
Play money.
Yeah, so it's a good question. So usually when we all build our asset pyramid, right, the safest assets or the core assets should be larger, yeah, which should be safe things, right? Usually people kind of invert their pyramid, and what should be constitute, because everyone will get inspired by someone and invest in that, which is nothing but speculation. Whenever you kind of take someone's advice who doesn't know much, say you invest where your friends are investing or your family relatives are investing, that is more speculation because you're not knowing where you're getting into. Usually for most people that play money should be very small, less than 5%. Usually that becomes a big chunk of the asset allocation for people, and the safer assets become very small. Usually the pyramid becomes inverted. So we say that play money should be very small component of your portfolio. When you are not having enough knowledge in your investing, those assets should be very, very little.
So fund of funds.
One question.
Yeah.
On the equity fund of funds, how many times have you switched between, I mean, the case is that it's the best in the market, right? That's how you propose it.
Yeah, so for example, I said there is not much consistency in the mutual fund landscape out there, right? Many fund managers have seen like what is top today after 3 years or 5 years, that may not be at the top. That's what we have seen. So we try to identify not the top performers, but funds that are more consistent in nature. So that gives you a steady, at the same time we also look at risk. So we try to avoid funds which have a red flag. For example, the churn is very high. For example, concentration is very high. So we kind of look at the processes of the fund house, meet the fund managers, ask those tough questions, succession planning, etc. And then we try to identify the fund manager. So on a churn basis, it's not necessary. We look at portfolio daily, monthly, etc. But it's not necessary we'll take action. There is a methodical way in which we have a tolerance for underperformance, and post that, if we think that things are unlikely to fall in place, we'll change that. So there is no set criteria, but we have seen in some years we have seen 0 changes, in some years we have seen even 3 changes out of 9. So maybe a 30% of the portfolio churn also, and 0% churn also. So coming, I mean, there are many investors who kind of have been patient. The value investing across the globe was going through a bad cycle. From 2017 till now, not only in India, but globally, value investing had a terrible time because there was so much money being pumped in by central banks, interest rates taken to 0 levels, that made money a lot cheaper, and that money was chasing growth. And in a growth kind of chasing environment, value goes through a bad time. And we are exactly getting into an opposite thing right now, and therefore there are higher chances that value may do well and growth may suffer because the environment is changing.
Just announced cut in excise duty on excise on petrol by 8 rupees and diesel by 6. So inflation might take a short break.
Inflation may take a short break. Indirectly, it will hit the fiscal deficit.
It will.
So somehow it will compensate in that sense.
Monetization.
Yeah. So in the value fund, whoever is a value investor, or who, I think there should be a element of value investing in your portfolio at all times, because value is something that we all are conscious consumers, right? Similarly, that should reflect in your investing as well. When you're not paying a high price for buying a stock, that is value investing. When a 2-year out value of a stock is say 100, and if you're able to buy at 60 rupees, that is value investing. So if you believe in that, a value should be part of your portfolio. So what we do in a value fund is a combination of these three things. Corporate governance is a must. We will not touch companies which are not good at governance. When there is questionable practices by the companies, their managements, we will not buy into those stocks. Second is liquidity. Those stocks have to be very, very liquid. Our liquidity criteria, a stock that trades at least 7 crores a day on an average for last 12 months on a daily basis, those are the only stocks that we'll buy. And valuations are very, very important. As per our estimate, if the value 2 year out of that stock is 100, we will not pay more than 60 to 65 rupees for buying that stock. So when these three elements come together, those stocks will be part of the portfolio. So our portfolio, given we are positive on growth profile of India for next 2-3 years, our portfolio is positioned for an economic revival. We are bullish on consumer discretionary. As income levels grow, as economic grows, there will be more spending, and therefore, over a lagged effect over the next 1-2 years, the consumer discretionary companies will do well, which is auto companies. Wherever we spend our excess money is where that comes in consumer discretionary. We are bullish on financials. Usually in a rate hike cycle, the net interest margins of banks usually expand. So we are bullish on financials, especially banks. We are bullish on materials because as economic increases and government capex into various things like infrastructure, there will be increased demand for materials, which is also a higher weight for our portfolio.
What is consumer staples?
Consumer staples is FMCG companies like Hindustan Lever, Nestle, etc. That from a value investor perspective, staples are expensive today. They have fallen a lot from their peaks, but they are still not value, and therefore we don't have a position in the value fund.
What about ITC, sir?
ITC, we at Quantum has a philosophy that we will not buy into sin stocks. Any company that is in tobacco, alcohol, gambling, we don't buy those stocks, and therefore we don't have it in our fund.
And what are the examples of companies in the second one, consumer risk? What is that?
In consumer discretionary, we'll have auto companies, we'll have, say, for example, jewelry companies, or anywhere you kind of anyone spends the excess incomes, 4-wheelers, 2-wheelers, etc. All those are.
Jewelry is like a Titan or something.
Yeah, jewelry is like Titan. We don't have Titan in the portfolio, in this portfolio, but we have in the ESG portfolio.
So what about LIC of India? LIC?
LIC, we'll come to that at the end.
So you have any PE fix more than that particular PE you will not invest since it's a value?
So each company is valued based on different criteria. Some companies are done on PE basis, some done on EV EBITDA basis, some on a replacement cost basis. So there are different methods on which you evaluate companies. So our research analysts will make models of companies, and whatever is the norm for that sector, based on that we will make a valuation component of it, and then we will value the companies. So PE could be a good criteria for any company. You could look at that. And we have, given that there will be increased demand for power, etc., we have a higher component of utilities in the portfolio. So our portfolio of the value fund is positioned for an economic revival. What if there are risks, right? What if our call on economic recovery goes wrong? Then what kind of companies will fall? Companies which are weaker, which don't have much cash, which are high debt, will face a terrible time, right? So if you look at, we have financials, 8 stocks within the portfolio. Financials will not get impacted much because they have leverage, but they borrow at one end, lend at the other. So we should not include. From a interest rate volatility perspective, it will not impact that. 13 companies in the portfolio out of 30 are net cash companies. They have cash on their books. 7 companies have very low debt equity. Debt is very low as a percentage of equity, so they will not be impacted much. 2 companies which are utility companies. Utility companies are regulated, have regulated structure. They have guaranteed business, and they have guaranteed returns. They cannot make higher returns, they cannot make lower returns. So 2 companies are from that utility sector. So overall, even if our view were to go wrong and there were to be high volatility, like interest rates going significantly higher because of inflation staying sticky, etc., then also our portfolio will withstand that volatility, given that it is stronger balance sheets that lie within the portfolio.
Which fund is this?
This is the long-term value fund.
You didn't say that, sir.
Sure, sorry. No, actually all these slides are for the value fund.
Okay.
So we are in that.
So you said you have exposure in discretionary also, FMCG sector.
FMCG no. FMCG is 0. Consumer staples is 0.
Discretionary you have only automobile and jewelry only.
No, I was asking more examples.
2-wheeler, 4-wheelers, then we will have
ACs, Voltas, like.
AC manufacturers. We don't have Voltas in the portfolio.
But technology we have, which is again a
Yeah.
growth, kind of growth, defensive growth.
Yeah, so if it becomes attractive, we'll buy further.
Discounts never pay these utility companies, right? So there is an element of risk.
Yeah,
They
but
take years together, sometimes they pay, sometimes they don't. Because
Yeah.
that's one area where even the a lot of governments give subsidy, like free power.
no, but what we have here is like companies like Power Grid or gas utilities, etc. So they are not
The infra
much
guys.
impacted by the discount.
Okay.
Sir, why you don't have exposure on this concept? Come to the
Yes.
what is that? Real estate, because you said the real estate growth sector is there. And second thing is.
So I said real estate activity is going to pick up. Does not really mean that real estate companies will make money. They are 2 different things.
Please elaborate.
So at one end, even if demand is moving up, it is coming out of slumber. Still they have inventory. Lot of companies are still in debt. So there will be a lot of selling happening, but prices may not really move up. Plus, they are also facing pressures from likes of cement, steel, etc. prices increasing, and they don't have much leeway given they are in stressed situation currently. They'll have no choice but to sell. So from that perspective, profitability may not really see a big increase, but activity still may remain buoyant. Over a period of time, they may, but at least for now, it looks a little difficult.
So could we look at the ancillary companies who grow, like your tiles,
Yeah.
your furniture,
Yeah, you can look at that. You can look at material companies. Yes.
So why is no exposure on consumer staples? Sir?
Consumer staples, from a value investor perspective, is still expensive. They are still trading at 50 times, 60 times PE. They were at 80 to 100 times. They have corrected, still at 60 times. So, still from a value investor perspective, it
But
doesn't
what is the
count.
historical average? They are always traded around 40.
40, 50 times. So, still they are above the long-term average still. They have corrected a lot from the top, but still.
See, for these companies in our list,
I mean,
returns versus drawdown.
when
Sharp
you see
ratio or something.
when you see a staple company coming in the value portfolio,
Yeah, I
you
know.
should say that value is emerging in that sector. So we had like post 2007-8, we did have staple company in the portfolio. It's not that we have never held
Okay.
in a value fund.
At time they are value.
Yeah.
And what we also miss is the entire commodity, like chemicals or steel. I think all are missing. I don't know if that
Steel we have, materials we have.
Okay. Okay, steel
We
is
do have exposure to Tata Steel in the portfolio.
So do we call Tata Consumer Products, GCPL, all as a staple
Consumer
companies,
staples,
or do we
yes.
call it as a different?
Correct. It's all in consumer staples.
But aren't they growing so fast rapidly?
They are growing. Some companies, some products are growing faster. But if you look at the likes of levers, etc.,
They are expensive as you mentioned.
Correct.
But there are certain companies which can match up to them,
Yes, I mean we do have those call companies in our coverage, but still it does not hit our comfort level from a value investor perspective. But in the ESG fund that we do have exposure to the stocks that you mentioned.
Tata Consumer has reached 8% ROC only this year. It was at 7
Correct.
below.
Correct.
Your fixed deposit gives you better return than Tata Consumer does in its business.
But the stock has given a fundamental fantastic returns.
Resource also does.
So, and one thing to say that value portfolio is real value or not, there are many who will call themselves as value investors, if you want to really knock at the door and see whether they are value or not, you should see this. What is the PE of the fund, of the portfolio, versus the PE of the market? So PE of the market is at trading 25 times, our PE is at 18 times, almost a 30% discount to where market is. Even if you see 2-year forward, market is at 17.7 and we are at 12.3. Again, a 30% discount to the market. So this tells you that indeed the value portfolio, given the discount that it trades at, is indeed value. So whenever you are trying to get into a value fund, you should see these statistics and see whether it is value or not.
So Chirag, can you explain that second point? Are we expecting a market to fall to 17.3 from 25 levels? 2 years earning forward, 2 years forward earnings?
Yeah.
This
Yeah, I mean, that
This-
comparison.
Yeah.
Yes.
No. As earnings growth of companies come in, given you are looking at a
So you're
price
saying
today
earnings-
and the same higher earnings tomorrow, the PE falls.
The earnings might go less.
Yeah, so forward PE is always lower than the current PE because of earnings increasing.
That's an estimation.
Yeah, that's a consensus estimates of all sell side brokers.
8%.
It is 8 times.
Or 9.
I mean,
Yeah, 8
which will
times.
translate to an
No,
earnings growth of
9%.
maybe around 20-25%.
Chirag, even at 18.3,
EPS growth of 17.2%.
so given at 18.3, current, the earning yield, even GSEC is better, so earnings have to catch up.
No, 18.3 times
Yeah,
earnings.
if you take the yield, it's
Yield.
hardly 5.
Yeah.
GSEC is today at 7.5 and inching up.
Correct. So
Long
either
end of
prices
the
have to
curve.
fall or earnings have to catch up.
Yeah, earning has to catch
So
up.
I think
that is
both
good.
will happen.
Yeah, 12.3 it makes sense. I think that's the time an interest rate will
Correct.
reverse.
Correct.
Otherwise, the economy will blow.
So you always look at that forward
Yeah,
number rather than
12.3
a
is
trailing
better.
number. Sure. And both will happen. Prices might also see some correction and earnings will see an uptick.
Yeah, and commodity easy.
Yeah. So this is an example of how if the environment actually changes where interest rates start increasing, a growth stock may fall more or correct more than a value stock. For example, a company with a growth rate of 20% and a company with a growth rate of 10%, the present value of, if say we start at 100, so if we discount at 12%, the cash flows increasing at 20%, and if we discount at 15%, which is a higher interest rate environment, a 3% higher interest rate environment, just because of discounting, that will fall, a 300 basis points increase in discount rate will lead to a correction in the present value of by 28%, whereas a slower growth company will see it fall. The impact of interest rate on the present value will only be 22%. So a higher, if interest rates were to increase, a high growth company will see their cash flows or present value estimations decline more than a lower growth company. So if indeed the interest rates are likely to increase, then probably being in value is better than rather being in growth.
But that depends on if they are growing on a borrowed capital. If they are doing it on the internal accruals, these things may not apply.
No, but
to those
you
companies.
you will look at discounting the cash flow, right? If you are a investor
No,
who is looking
interest
at
rate.
10-20 years of earnings and you're discounting into present value and saying what is the intrinsic value of that company, then probably your estimation what it was before interest rate increasing and after interest rate increasing will see a more decline in present value estimations than what it was before.
But if there is an interest cost in that.
Yeah, but you have to take the interest rate to discount the cash flows, right? No matter what the company uses, equity, debt, or internal accruals for funding that growth, but you will discount at a rate or to bring the future cash flows to the present value.
True. But there is also a theory that with the global population growth almost getting saturated, not really growing up, so they're saying the future, the inflation may just not be going up unless it's a supply side destruction. Because demand side, it's not going to really spike up.
Depends.
Even
right?
today's
I mean,
inflation is more on the supply side than on the demand side.
Yeah, supply
Mostly.
side may also continue to suffer
Because of the
given the
population
slowdown we are
saturation.
seeing, given the greenification that we are seeing.
Yeah,
You know,
exactly.
all that may lead to continuation of the supply side impact.
Exactly.
So what levers that we saw from cycle between 2002, 2003 till 2007-8, similar drivers that we are seeing for economic growth today, similar kind of environment where inflation was high, interest rates were increasing, similar kind of growth, inflation, interest rate environment that we're getting into, and similar levers like real estate, IT, etc. were also levers. Then value did really well as compared to growth. So it could be time for value. So if you're looking at, putting money in equity markets today, this could be a better bet at this point in time, given the scenario that we are getting into.
Any Adani Group companies investments?
We don't have investments in Adani Group companies, nor we have investments in Reliance Industries.
Any reasons?
I mean,
Only sin you said you won't invest in sin companies, but they are not.
no, we have seen some corporate governance issues with both the groups, and therefore we kind of stay away from any company which has any corporate governance issues.
What kind of corporate?
So-
You should not make
I think I can-
statements.
I can-
Substantiate it.
Yeah, sure. So we have seen, I think if you go and look at, there is a report by a Canadian company called Veritas, which has a detailed report on corporate governance issues at the Reliance Group, wherein, even in the past, minority shareholders were not treated equal to the promoter group. Whenever that separation happened, or whenever, even before that, there were certain areas where they had not treated the minority shareholders at par with the promoter group. So our thesis is, whenever you shake hands with someone and you don't get 5 fingers back, you don't shake hands with that person again. So we have seen that minority shareholders were not treated with...
Which are those companies which shake hands and with minorities and gives all the 5 back?
There are many. Look at Tata Group companies, right?
Okay, Leo, Tata.
No. There are so many companies. There are so... whatever stocks we have in the value fund meet our corporate governance criteria, where we are happy to shake hands with them again.
Chirag, if you allow me, I have a point just to add. What I read recently about Reliance, they had made a huge, just to add what you're saying, they had made a huge discovery, as most of us are aware, in KG Basin. That's on the gas. And that's what they initially told so much. But then they've been instead of pumping it out, they've been waiting for the pricing to climb.
Yeah.
Okay, BTU gas. Today, if you look at the BTU price of the gas, is almost 50% more than earlier. And now they started pumping more, and that is actually slowly reflecting in their balance sheet or P&L, and going to reflect in next couple of quarters. I don't know if this can be directly told as a corporate governance, but just what I read in maybe surely you are aware of it. Yeah.
That's more of a business strategy.
Not
Yeah.
ethical practice.
No, but then we are all saying cylinder price has gone up, right?
I don't think that is a corporate.
Let's, in the interest of everyone, I think we should finish this presentation, and happy to take any questions after that.
So what exactly does it mean? Sir, but only if I invest 100 rupees, it will come down to 2002, some 60 rupees.
So that was the dot-com bust in 2000, which led to the market decline, and then we saw the run-up in equity markets, and value did better than growth in that cycle.
Sir,
Yeah.
can you show a similar slide for India growth and India value? Do you have a
I don't have it here, but happy to have it sent to you later on. But even India value, India growth went through a similar cycle at that
How
point.
does it
Now, after
compare
2007,
with
it never
how does it compare with the world?
After 2007, because I'm seeing it from 2000 to 2007 or something. Like
Yeah.
that. After 2007, it never happened.
It would have happened, but there would be brief periods between where, like 2009-10, the rally that we saw after markets bottom, value did really well. But post 2013-14, I think value had a difficult time, because we were in a scenario where central banks were pumping in a lot of money at that point in time, interest rates were low, and that led to the value not doing so well and growth doing well.
Chirag,
Because money was cheap and plentiful available.
Chirag, just one thing. See, while value is absolutely fine, but then just to look at give a different perspective. See, India is still kind of a growing market.
Yes.
Even the per capita income is very less.
Yeah.
Okay, unlike the matured Western markets. So definitely that would mean the India by itself is a growth story.
Correct.
While if you even look at a Google, India PE, most of the companies are more than what Google PE is. That's because we are in a country which itself is in a growth phase.
Yeah.
Does it not make more sense to chase growth companies than a value company?
Yeah.
Because as a
so
country
we are
itself,
often being asked, like we manage money for a lot of foreign investors as well. So we are often asked by those foreign investors or many groups out there, what is a value manager doing in a growth market?
Absolutely.
Right? So even in a growth market, it goes through phases and cycles, which gives you opportunity to position your portfolio in such a way that you kind of take advantage of those cycles, because there are pricing inefficiencies, market cycles across different sectors that help you to take advantage of mispricings, because every sector also goes through phase of bull and bear, right? So it gives you an opportunity to buy it cheaper when it's available and position it so that you don't take overt risk. At the same time, you bank on the growth of those companies. It's not that we don't look at growth of these companies. We do analyze that as well. But based on that 2-year estimate, is that stock available cheaper or not? So you always have a cushion of safety when you're buying it from a value perspective. So our numbers of earnings also capture that growth in companies as well. It's not that we don't look at growth.
So it's a
but at the same
cyclical
time,
growth.
we also look at catalysts for that growth.
So you can call it cyclical growth?
Yeah, I mean, we look
Because
at whatever is
putting money in
practically
automobile.
achievable from an earnings perspective for that company. So the company will likely grow at, say, if the economy is growing at 12%, if the company is likely to grow at 20%, we will estimate at 20%.
Like
in our
automobile
models.
is in cyclical growth, you can
Yeah,
say.
so we do look at, we look at those growth.
Okay.
And we look at more normalized growth.
Sir, in India, in the past,
Yeah.
value companies have grown better than growth companies, or growth companies have done better than value?
So all companies have grown. When I say value companies, is not that company is value or not.
No.
We want to buy it.
Which one has performed better? Growth companies?
So even the value companies have been growing, and even the growth companies have been growing. Only growth companies is you're trying to buy. Whenever a growth manager buys into a stock, they say that growth will compensate for the higher valuation of that company today. Whether the value manager will say that I will only buy when that company is available cheaper to me, then it's value. What I estimate 2-year out value, that company should be available cheaper than that 2-year out value, then only I'll buy that. Growth manager says even it is available at that fair value, the future growth will compensate for the high valuation today.
Absolutely.
So that is what is the difference. Both companies will keep growing, and there will be phases, cyclical, for each of the sectors in which they will have to go a very high growth phase and a bear phase as well. Like for example, auto companies or two-wheelers, they went through a very good cycle. Now they are all not seeing good sales currently. So they are going through a bad phase right now, which will reflect in their valuation. And whenever a cycle for a sector goes through a bear phase, its valuation significantly falls. It allows a value manager like us to buy it significantly cheaper. And whenever the cycle turns, we will take advantage of that growth cycle.
Sir, in the present scenario, does Quantum have any vision for technology like artificial intelligence and such companies which are going to be the companies of the future?
Unfortunately, we don't have many companies listed today that does AI, but there are many technology companies like the big technology companies which are part of the portfolio, may be aiding that process. So we do have some exposure to that. If you talk to any big company like TCS, Infosys, all have started a division of looking at AI and those kind of things. So they are also looking at those new areas of growth and working on that. It may not be their full business today, but they do start verticals looking at the new growth areas as well.
Thank you.
For value to be a primer for you to decide to go into that portfolio company.
Yeah.
There are, in today's AI, machine learning driven world, value itself can be a disruptor, right? For example, Nokia of yesterday was of huge value, today there is Nokia.
Yeah, so for example, growth is not only enough. We'll have to see whether there are catalysts for growth or not, right?
Yeah, but how do you
So there is a difference between what is a cheap stock and what is a value stock.
Okay.
We don't want to buy cheap stocks. Any company many companies may be cheap, But any company that has that catalyst for growth, for the company to reach back to their intrinsic value, we are buying at discount today, but it should go to and reach its intrinsic value, and it needs those catalysts to play out for it to reach that value.
No, in the
There are many value traps, so you need to avoid those value traps.
Exactly.
A classic example in our market is BHEL, right? It was a good growth company, but it didn't have catalyst for those growth, right? And you see where the company is and where the stock price is, right?
And
So
even
we look at those catalysts whenever we analyze.
even the domain or even the space where they operate in can be a disruptor. Like for example, you had Apple to challenge Nokia, and then
Yeah. So we have to take consideration of all those things.
But then with IT,
Can we have questions at the end of the?
Yeah, we'll have discussion at the end, please. We have just a few slides. We'll quickly run through that and come back to the great discussion. India ESG Equity Fund in July 2019. It's about to complete 3-year track record. And the journey has been really good. And I think there is merit in looking at sustainability as a driver for overall returns. So what we do in this is two things. We look at ESG, which is looking at the environmental, social and governance practices of companies. We look at whether the company is financially stable or not, because we want investors to make returns at the end of the day, right? And no matter how green the credential is, if it is not making returns for investors, then it's of no use, right, from an investment perspective. So we look at ESG, we look at whether the company is financially stable, because they also need stronger balance sheet to be able to carry their green ambitions that they have, right? If they want to become a better company, they'll need cash flows with them to support them. So they should be financially stable in a way. And there should be liquidity and diversification across sectors. We'll look at, so the other fund that we had, long-term value equity fund, was a value fund. This is a value agnostic fund. We don't look at valuations, we look at financial stability, we'll price in any risk of the future. So financial stability is not only past, but also future. We look at whether the company will come under problems from a cash flow perspective, whether it will go belly up, what are the risks in that company. So we look at good ESG traits, good financially stable, liquid stocks, and very well diversified portfolio across sectors.
Is it having a growth theme or theme or?
Yes, more or less it will be, it's a quality theme, but you could say it's a growth theme.
market cap? Is there any market cap above which only you will buy?
No, it has to be liquid. Liquid means it should trade at least 7 crores a day on an average for last 12 months.
Okay.
So which are very, very liquid stocks. Plus we engage with companies, we try to make them better on their ESG traits, we try and ensure that they are on a good path. They have certain targets, credible plan to reach those targets, etc. That is what we try and nudge them to become better. So how we evaluate companies on their ESG traits, we kind of look at, scout for a lot of data from primary sources from the company as well as secondary sources, because currently there is not much disclosures from companies. We have to look at a lot of data sets. And wherever we see problems, we penalize those companies or not buy them at all if there are problems. So we do arrive at an ESG score just to bring in some standardization across companies. And we want to avoid weaker companies from a financial perspective. So any company which has debt equity less than 1, return on invested capital greater than 12%, and free cash flow growth of at least 7% is the companies that we will buy into this fund. And this is not only historical or current, this is also futuristic. And if you look at our portfolio is driven by ESG, when we say, because each of our fund is true to label. We want fund to reflect the characteristics of the fund. And here, wherever the ESG scores are higher, our weights will be higher, subject to certain sector guardrails that we have and financial stability of those companies. So we are higher weight in consumer discretionary, significantly higher than the index. Materials we are higher weight, and we do have a higher weight in staples as well, which we are increasing currently because of the fall that we have seen. And we do have higher weight in industrials. which is also one growth area that we see because of higher growth in the economy that we will have. Here, on a historical PE basis, the fund is expensive. As you rightly said, is it growth characteristic? To some extent, yes, it reflects growth characteristics. But if you look at the earnings growth, given these are quality companies, leaders in their sectors, the earnings growth profile is significantly better than what you have for the index. Like for example, BSE 30 earnings growth 2 year out is 17.4%. This is 24.18%. So significantly higher growth profile as compared to what you saw in value. So value is cheaper. So if you have a combination of value fund and this fund, you cover kind of you're well balanced. It will be a good barbell strategy for you. So for equity investing, if you have 3 funds in your portfolio, you have significantly greater diversified exposure to all kind of styles in equity investing. So you have equity fund of funds, which have 9 funds from the large cap, non-large cap space, plus you have value fund, which will work when certain other styles are not working, and you have the ESG fund, which is kind of a futuristic, sustainability-driven strategy. So if you have those 3 funds, you are set for your equity investment needs. Quantum equity fund of funds, again, it's an extension of why you come to mutual funds. You come to mutual funds because on your own, you don't have time, expertise, inclination to directly invest in stocks. And that is why you come to a professional and expert who will pick stocks for you and build a portfolio for you. Similarly, there are more than 500 equity schemes today. If you don't know which stock, which fund to buy, and if you want a good, well-researched portfolio or well-monitored portfolio, then you come to equity fund of funds. So you get a research-based fund selection, looks at consistent performers across market cycles, balances between risk and return. Usually investors, when they invest on their own, they just look at returns. They kind of not look at the risk elements usually. We do look at that. We try to diversify across styles, across large cap and non-large cap space. And you just have one investment to track and you get exposure to 9 different schemes. So returns last 10 years has been 14.6 and since inception it's been 13.78. So that was one question that we had. Again, if you look at the risk elements, if you look at, for example, the Sortino ratio or the standard.
Is it compounded or what is it?
This compounded, yes.
Let us see this slide before, just for a second. Previous second.
Okay.
Almost equal to benchmark returns or less than that?
Yeah, almost closer to the benchmark return. Long term, since inception, outperformance.
It is averaging out, right? I mean,
yeah.
It has to be close to the benchmark because it is averaging out a lot.
Yeah, it is averaging out. Plus, if you look at certain risk ratios, for example, down capture ratio is 91 versus if you are having the index at 100, then it's at 91. But that tells you it kind of protects risk on the downside as well. And standard deviation is also lower. So from that perspective, it is a better, sharp, risk-adjusted returns, if I may put it that way.
So let us discuss the one second. So let us discuss this Sortino. Kindly explain to everyone.
Yeah, we'll come to that slide later on. I'll quickly finish.
Oh, okay. You want to finish it?
Yeah. So if you look at the large cap exposure, is close to 71%, and mid and small cap is closer to 22%. Cash held by the scheme, equity fund of funds and the underlying fund managers is 7%. And we do give the entire, not only funds that we have taken exposure to, but the entire portfolio that comes because of that exposure to those stocks. So overall, if you see, these are the top 10 stocks and top 10 stocks account for 36% of the portfolio.
These top 10 stocks you are talking about.
Yeah.
Are these value stocks?
No, these are not value stocks.
So in a value fund, why are these?
So this is not a value fund. The long-term equity fund is a value fund. This is an equity fund of fund strategy.
Okay, no. Even in the other one, I think I heard you say you have all the technology companies.
Yeah.
Yes. So are they value stocks?
Yes, they are value stocks. And if you look at what is the sector exposure that fund of fund gives you today, is higher exposure to consumer discretionary as compared to BSE 200. Financial is almost similar. Industrials higher, materials higher. So these are the levers which we see if the economic growth were to improve. These are the sectors that are likely to do well, and it has decent exposure in those sectors.
Why is it that in whether it's a growth this one or a value stock or any other,
Sure.
The technology stocks are there in all of them.
Yeah.
So if it's either it has to be a value stock or it has to be a growth stock.
No, there could be very different stocks within that sector as well.
No, I'm talking about the same stock. For example, Infosys or TCS is there in value risk and growth also, and in some other.
Correct.
So it cannot be all three at the same time. That's what I'm
Why not? It may be offering a growth as well. Plus, it is corrected from the top, and it could be offering a.
It could have corrected. I am not saying it could not have corrected. See, what I'm saying is.
So there will be.
As a fund manager, when it has come down, the value fund manager should be taking it, not the growth. He has to dump it at that point of time. Correct?
No, he has a point. Yeah, see, just if I can take that. See, few years before, you are right, few years before, the entire IT along with pharma was called defensive. Post-COVID, because of the digitalization, they became a growth stock.
What I'm saying is,
It's a.
What is the purpose of the fund manager? To dump something when it is not a value proposition. I am talking about a value.
Sure.
And growth proposition.
So don't see.
All the three fund managers are having the same stock.
See, a cyclical growth stock, a cyclical growth stock.
So a value stock doesn't mean that it's not a growing company.
It may be a growing, then it does not have the value proposition.
No, not necessary. Price of a stock is determined by the market, and market may not be pricing in the growth because everyone will have a different lens of looking at it. What you may see as growth, I may be saying that it's a trap. It may not be growing company. Why people buy and sell at the same time? Because their views are different. Some may see growth in that company, some may not see growth in that company. It's not that every fund manager will be have a.
Either he is wrong or you are wrong. Both cannot be right.
Correct. It could be, yes.
One question on this.
But value stock doesn't mean that it's not a growing company.
Correct.
Only today it is available cheaper.
Point of time. See, you are saying there are cycles.
Yes.
Yeah.
So that proposition comes at only a certain point of time for value or for this. So at that point of time only you should be having as a fund manager, he has to take it only at that point of time.
No, certain companies say today.
In the life cycle, all
logical algorithm.
Yeah. See, you have to understand the difference between a cyclical growth and a secular growth. Okay. Yeah. The key difference is cyclical growth and secular growth.
Chirag, just one clarification which comes on the slide. So let's say Infosys is available today at 700.
He's asking for dumping.
You picked it up.
Yeah.
Okay, after 5 months, 6 months, it's gone to 1400.
Right.
Will you dump or will you keep it?
Depends.
It's growing.
No, it depends whether it's
in the value portfolio.
Whenever the kind of process that we have, we do have a buy and sell estimate for each and every stock.
Correct.
When it comes to our buy limit, we buy. Whenever it reaches our sell, we will review that stock at that point in time, given that are we missing on any assumptions that we have made.
Correct.
Right? If there is no point in reviewing that stock or upgrading that stock at that point in time, we will happily sell it above our sell limit.
Got it.
Right?
Now,
So there could be a stock, for example, what you said, like a value investor, we bought it at 700.
Correct.
Today the stock is at 1,000 rupees and still has a growth profile, increasing growth profile. So there could be points where a value manager as well as a growth manager will have both have that same stock in the portfolio.
That's what I was trying to ask.
So it's not that value stocks are not growth stocks, are not growing companies rather, right? Value companies are also growing companies, but today the market is not valuing that growth properly, and that is why it is available at a discount, and therefore value managers go and lap up that stock.
So when a value manager picks a stock, it means that the stock is has value at that point of time. And if he's retaining it in the portfolio, it means that the company has a growth potential.
Still.
Now it has not reached the sell state where he wants to.
But then it should not be this one, when it is having the growth, when you are looking at growth as this one, then the value proportion has gone there.
No, all companies are growing companies in India. Only when they are available cheaper, that is when the value manager will buy it. So don't mistake that growth, values to funds don't have growth stories, right? All companies in India are growing companies. Only when those stocks are available cheaper, that is when the value manager will go and buy.
You can take a Nifty P as a reference, and anything 50% more will be a growth.
Everything looks cheap. I mean, from the top.
No, it's a different definition for different people.
So for the value manager, it's a real, task to pick up which particular is the real value, because as you say, not everything you buy because it's cheap. You buy only when there is a value. We are ready to pay 60 to reap 100 later.
Correct.
Right, and that can happen only if it grows. I mean,
so all companies in India will see growing profile. I mean,
so what
generally.
do you feel about the general market, which has come down 40? Like there are certain blue chip companies which has come down 40-50% from the rise.
Yeah, but it could be that its intrinsic value could be 100, and they were already trading at 200, right?
So
it may still not become intrinsic.
So there were excesses which has been
correct. And somewhere you have generally seen some correction as well.
Sir, how is the intrinsic value determined?
Yeah. So correct. So any company will have a revenue base, will have cost, and will have profitability. And profitability is nothing but earnings of those companies. So we estimate 2 years out, based on our study in terms of competition, in terms of its growth, etc. What will be its revenue? What will be its cost? What will be its profits and therefore earnings of that company? And if it generally trades at say 10 times PE, we will have a band in terms of what band it usually trades. So say a company may have a band of 10 to 15x PE, which is generally its trading band, right? And we will ensure that the future estimate, if it is available at the lower end of the band, let's say 10 times, then it will, so we estimate the future earnings as the intrinsic value of that company, plus the band at which it's traded. So 10 times, say if its earnings is 100, and if it is trading at 10 times, then 10 into 100 is 1000. So if it is available at 1000 rupees, it will be at the intrinsic value at which we should buy, right? Intrinsic value is nothing but future estimation of earnings of that company.
How much future do you estimate? Is it 1 year, 2 years? Or
2 years.
2 years.
Yeah.
So here the fund of funds means you look at other mutual funds.
Yes. So we look at, it's only other mutual funds. That fund will not invest in any quantum fund because of the conflict of interest.
There are the weightages that you showed is actually a consolidated.
Yes.
You also ensure that there is enough diversification.
Yes, at the stock level, at the sector level. Correct. So just fast forwarding quickly to
large cap will pick up similar set of funds, so you will not invest in all.
Yeah, correct. So if you look at the equity fund of funds on a trailing basis, again, if you look at the PE is at 32 times expensive than the BSE 200 at 28 times. But again, if you look at the earnings growth of companies is 24% versus 18% for the index. So again, a superior growth profile, again likely to be a growth portfolio. So coming to, we do believe that you should have gold exposure within your portfolio. It's essential because whenever markets are not usually performing well, gold helps during those times. Generally, we have seen that trend happening. And we think that gold ETFs and gold saving funds are a good way because they are very, very liquid instruments. And therefore, whenever you have to rebalance your portfolio as well, it is helpful if you have investments in liquid instruments. If you look at one of the biggest driver for gold is real interest rates. Whenever we have seen real interest rates usually go down or stay negative, gold usually goes up. But this time, real interest rates have reached to levels we have not seen in last 50 years. right? This is the US market. So it's at close to -6% real interest rate. So if you are a saver in US and if you have put money in fixed instruments on a real basis, because inflation running high, you're losing on a real basis 6% every year. Usually gold reprices during those times, but this time it hasn't done as equally as it has done in the past. And there are reasons for that. But one important thing, gold at the end of the day is like a currency. Right? Even central banks hold it as part of reserves. RBI holds it as part of reserves. 7% of RBI's reserves is gold. They are trying to increase it, and like RBI, other central banks are also trying to increase it. So over a period of time there will be ups and downs, but gold is priced in US dollars, and so usually it will track the money supply growth. How much they are printing currency, that much we will see increase in gold value over a period of time. There will be ups and downs, but generally that's the trend.
How do you see it in future?
And currently, I think they are saying that they will unwind the balance, Fed will unwind the balance sheet, not the money supply will go down. But currently it is undervalued from that perspective. And may likely remain like this for some time. And there are reasons for that.
Chirag, but in the Indian context, rupee weakness will automatically...
It will help. So in the near term, from a dollar gold price perspective, it is likely to remain range bound for some more time, because at one end we have real interest rates negative, we have geopolitical issues, we have war going on. At the other end, Fed is saying they are getting more aggressive with their monetary policy. The market is trying to price in the future, and therefore it will remain range bound in the near term. But we have seen the US economy is already slowing down. There are leading indicators suggesting that US economy has been slowing down, be it retail sales, be it employment growth. If you look at those factors, real wages growth, they are all kind of stalling, saying that US economy is likely slowing down. So if that happens, with the pressure in terms of the US Federal Reserve removing the liquidity from markets, they are increasing interest rates, making the borrowing difficult and costlier. The economy will further slow down. And we have seen that as economy slows down, markets will react. Also, consumer spending will take a hit. Given inflation is also very high. So at some point in time, we anticipate that US Federal Reserve, Central Bank of US, will take a U-turn in its policy. It may be 6 months, it may be 1 year, but we anticipate, if you look at 2017, 2018.
What is your anticipation for that?
Do you think
when will it happen?
Within a year's time.
It will reverse.
They'll reverse the stance that they have taken today.
It will hit the floor before it turns up, like it will go to a recession?
No. There is a likelihood of US heading into recession.
Because each time Fed has increased interest rates in the history,
yes,
it has overdone it.
Yeah.
Compared to the requirement.
But if you look at today, you are at the lower bound. Even if they increase it to 2%, which is even far from normalization. Usually the rates in the US are at 3-4%, 4% largely generally normalized. But still they will not be able to reach that kind of level, given where they are today. So even if they do 350 basis points increase, still it will take their rates from current 1% to 2.5%. So they'll still be far off from that normalization that we have seen. So we think that they will take a U-turn, and there are evidences in the past. If you look at 2017, 2018, they tried to unwind their balance sheet, and within 1 year, they could only do $700, $800 million, and they had to reverse their stance and move into, again, a loosening monetary policy. So we anticipate that given the state of the economy, given the run-up in the economy that they have seen, there are likely chances that the economy will slow down and cause the Fed to unwind or reverse their stance. That will be the trigger which will reprice gold. So until then, we anticipate that there will be a range-bound movement in gold. There are enough supports for gold. At the same time, there are headwinds from the stance the US Central Bank has taken, which will lead to a range-bound gold prices. Again, what Sir said, that rupee may likely weaken from here, which will be a support for Indian gold prices to some extent. And post post when the US Fed, whenever they change their stance, it will kind of lead to a repricing in gold, and gold should reflect or catch up with the difference in money supply that we have seen. They have changed certain terms for that conversion. So I don't know whether they will stick to it, not stick to it, where US, Russia, China, etc. will take that, how far they will stretch it. It is anybody's guess, but gold, whatever dominance of US dollar has been, I think slowly it's been dwindling. We have seen that share of US dollar in payments of global trade and services payments is declining. Share of reserves of US dollar is declining. So we are seeing enough trends shaping up which are slowly saying that the dominance of US dollar may be dwindling to some extent. So we have seen that characteristic play out, which is also where incrementally a lot of countries are trying to shift some of the reserves into gold. So that will also be a support for gold prices.
The US dollar dominance is going down. In what way it is going to affect Indian currency towards US dollar?
So, we do still have a lot of our reserves parked in US dollar itself. For India, I think it will be good if there is a bilateral trade that starts and we are able to pay instead of dollar into our own currency for our imports. That will be a big improvement for India overall from a external payments perspective. But it's difficult to say which country will assume dominance. The RBI has taken a good stance to diversify its reserves. They're slowly doing it, but it's been very, very slow. Dominance of US lending is a threat to US more rather than a hurt to us. Whoever is asking for their currency, if India is better poised from an inflation dynamics perspective, interest rate dynamics perspective with that economy, then probably it will be better for us as compared to what we have with the US today. So from an India perspective, I think it will still help.
The US economy decline in case.
Yeah.
That will not impact the exchange rate between dollar and rupee.
It will impact, no? It will impact. It may lead to rupee depreciating lesser as compared to what the trend that we have seen so far. Because US dollar may be under pressure and may be sliding down, which will mean that rupee may appreciate or not depreciate as much as what we have seen.
Chirag, what is this dollar index?
Dollar index is a basket of currencies that make up that index, and largely the developed market currencies have huge allocation in that dollar index. Like for example, euro, pound, and the yen are the major factors or major allocations within the dollar index.
So that move on up.
So that
has an impact on.
Yeah, so that has gone up from 90 odd levels to 104, 105 to 103, 104 today, which means that dollar as a currency has gained vis-a-vis most of the major currencies.
So that impacts the equity markets a lot.
Yeah, whenever dollar index rises, and whenever there is interest rates increasing in the US, we have seen that money gets pulled out for emerging market economies and goes into US. That's generally the trend that we see.
No, while US dollar, Indian currency has depreciated.
Yeah.
Against US dollar. In UK, sterling it has not, it has gone up.
Correct, because sterling has also depreciated. Sterling has depreciated more because of Brexit vis-a-vis the US dollar. So, just a last slide on how many investors have invested in Bitcoins?
So do you have any portfolios from
No, and we don't recommend as well. It's very difficult for us to identify where the value for that cryptocurrency is coming from. It doesn't have any intrinsic value. The thousands of cryptocurrencies, you cannot tell what is the difference between each of them.
Can you explain?
Today I can remove
18,000 currently. Going further discussion, cryptocurrency.
Yeah, so there is a technology called blockchain, which is nothing but a distributed ledger, wherein the record keeping is permanent. Once a record is created, no one can modify that record. You can build more record on that, but you cannot modify what has changed. So there is a virtual currency trading on that blockchain, meaning that if you have bought that blockchain or the currency, virtual currency, it will get notified in that blockchain system so that you know that you are the owner of that currency, right? So you can change, you can sell it to someone, and that blockchain will get notified that you have sold it to me, and therefore, I am the owner of that currency today. So that is the system in which it works. But it does not, I don't know where the value comes from, it doesn't have intrinsic value. Second, if you look at, there are so many types of cryptocurrencies and there is no differentiation between any of them. Today I can launch Chirag cryptocurrency.
So is it a scam? Is it a scam?
It is, I mean, I don't know how to value it, right? It is, for me.
That's why, like you said, when there is no value from which it is being launched, something is being launched by you, crypto, like you said, Chirag crypto.
Yeah.
So if there is no value, you can put a value of 1 billion, 10 billion, 100 billion.
Demand supply. It's a demand supply.
The only thing that they have said that there will be limited amount of cryptocurrencies, and therefore it is, according to me, it is more speculation.
It's like a penny stock actually.
On nothing. Speculation on nothing. There's no value.
So I think it is one of the bubbles that we are seeing emerge.
It's not a scam, it's the different value for different people.
Where is the value coming from?
Promising
Where the value coming
usage
from?
of the
Is there some asset on it?
And one more thing that, so far there was only one thing that challenged the central bank's monopoly on money, right? It was gold so far. And that also is there because it was there before 5,000 years. It's been carried out, and it is difficult for them to shift away because the people have accepted that as a form of currency, right? So it is still staying. They will not allow probably any other competition coming, so there could be a regulatory crackdown at any point in time. So more or less, currently our view is we may be completely wrong about it, but it is more looking like a speculation or like a bubble.
Why do you say we may be wrong? No, when there is no asset base
correct.
for it.
I mean, that's our understanding. I mean, all the buyers may be looking at it with some different lens.
It could be an inflation hedge. It's an inflation hedge. Because example, you take somebody in Sri Lanka, okay, their currency has depreciated because of the inflation.
Yeah.
If a Sri Lankan, instead of holding his currency, if he is holding Bitcoin, there is no loss of value. So somebody who held 1 lakh rupees, Sri Lankan rupees, if he had put his money in Bitcoin.
also become half from the top.
Yeah,
right?
but then I'm saying, but now it is like that. But otherwise I'm saying it's an inflation hedge, foreign exchange hedge.
I mean, there are so many better inflation hedges out there. I mean, if you could have gold in your portfolio, or if you had some other foreign asset in your portfolio, it could have become much better hedges than what Bitcoin has proved to be.
See, as we said, when equity and some of the like a bond yield goes down, and those there are different.
No, it's
scenarios.
not performed right. Equity markets have collapsed, and Bitcoin has collapsed along with it. It's not acted as a hedge.
See, they are anticipating it to be a virtual currency for the virtual world. That's what the
Yeah, we are getting into the world of metaverse, etc., and they are saying that it could be probably. I think gold is anyway a better place to be, and we would say you stay away from the likes of cryptocurrencies. With that, I'll come to the end of my presentation, and thank you so much for coming today. I'm happy to take any questions that you may have.
foreign institutional investments, right?
Yeah.
FIIs have pulled in last 8 months 4,80,000 crores and daily selling at the rate of 3,000 to 5,000 crores. Okay, they are curbing liquidity at every level. Okay,
Yeah.
we are down from 18,500 to 15,700, right?
Yeah.
87-day EMA, right? 87-week EMA, right? So whatever we do in terms of performance, the valuation perspective and US markets are being in bear territory almost now.
Yeah.
It is down to 30%
Yes.
between Dow Jones and Nasdaq.
Right.
So what do you really see? Because all the performance, every fund or every bit of investment depends on, we may deny it, we can say long term, because whatever you invest becomes automatically long term if you are in loss. Okay? That's my experience, because you start with short term and you end up long term, and every boom cycle you kind of try to sell out those things, right? What's your outlook, please?
I have to add one more thing. These kind of sessions start when the market is in such conditions. Always. It's always.
Those kind of sessions, and we do travel to all countries.
No, but it never happens when it's in a bull cycle. You will never have time for.
We have been doing it since 2009.
See, by the way, I want to.
We have been doing such sessions since 2009 until COVID hit. I was here, I think, in 2019 as well, also when markets were in boom. I think we did a session here in 2017 as well when equity markets were at record levels. So we do keep doing. We are maybe different than what you normally see.
No, I see most
managers are busy when market is high.
Yeah.
I'm generally seeing for the past 25 years I've been seeing it.
No.
In this cycle it is.
So since 2009, every year we would have done a part to profit event in Bangalore.
Yeah.
Chirag, I have been your member in Quantum Long-Term Fund since 2006.
Right.
Okay. And I have seen 13.8% kind of growth every
Yes.
CAGR every year for last 16 years. Thanks for that. And I have been a lifetime member of Equity Master Aghora. You being the votaries for long-term investment and have been doing it so well through so many newsletters and all the things, right? I really want to see what is your outlook on that question I asked.
Yes.
Because the FIs have been weighing so heavily.
Yes.
And they don't seem to be stopping if you see the F&O positions. Okay?
Yeah.
They have a huge amount of maintaining it so for last 8 months.
Yeah.
And that turnaround until it happens, it's very difficult to see how we are going up.
Correct.
Okay, if not going down. Thanks to the retail investors and the domestic mutual funds, they have been just holding the water. Okay, otherwise you would have survived without any breath of air. Right?
Absolutely. Absolutely. So, as I said initially, I don't know if you were there or not, in 2008 when FIIs removed around $12 billion and our investments were around $3 billion, we fell about 60%. This year, they have removed $16 billion. It will be more if you count from October onwards. Our investments have been close to $12 billion. We have fallen by, till April, we were down only 4.5%. Look at the difference, what happened in 2008, what's happening now, right? There's a big counterforce that's helping us currently. Whether that will continue or not, it's anybody's guess, right? There are new investors who have come since last 2 years. They have not seen a real crackdown in markets as yet. So we don't know how they will behave, first. Second is, whenever we have seen dollar index increase, whenever we have seen interest rate in the US harden, we have seen money being pulled out of equity markets in emerging markets. Thirdly, India within the emerging market basket was very overvalued if you are looking at end of last year, right? Even today it is slightly overvalued. If you look at China, like of Indonesia, etc., India is still overvalued. So from that perspective, there is still some scope for these FIIs to withdraw. But if you look at, if they were to seriously evaluate emerging markets, India stands out. From a growth perspective, from a stability perspective, from a regulatory perspective. So these FIIs, sooner or later, will come back into Indian markets. Whether they'll come now, whether they'll come at 15,000, whether they'll come at 14,000, it's anybody's guess. But our guess is around the long-term average, they will start of PE around 18, 19 times. They will start coming into Indian markets.
Why are they withdrawing?
So usually it's money going back, given liquidity being sucked out by central banks or likely to be sucked out.
If there is going to be value here.
No, they also do reallocation, right? They are look.
There are fund managers there also.
See, correct. No. So they have to look at from their overall basket perspective, and from an overall basket perspective, India allocation is minuscule for them. They are not even 0.5% even for these long-term investors like pensions, sovereign wealth funds, etc. They are not even 0.5% allocated.
All the more, if it's minuscule, it's all the more.
No, but within that emerging market, they will do reallocations. They will also look at whether being in US interest rates makes more sense. So when they pull out from emerging markets, and India being part of emerging market, they will see that money going out. Sortino ratio is nothing but a modification of the Sharpe ratio, where you look at returns on the portfolio minus the risk-free and look at standard deviation of downside returns, right? So that is what the Sortino ratio is. It's also to look at what is the alpha generated by the fund over the risk-free, and look at the standard deviation when in downturns. So that is what the risk the fund has taken to generate that higher return when you're looking at the downside risk of that fund.
Points 369 we see and 392 we see, Canara Robeco.
Yeah. So this is the best one, right?
Yeah, the best
Canara
one is
emerging
392.
equities.
Yeah. That is Canara Robeco.
Yeah. And all the sharp Sortinos are better than the market, right?
Yes.
So
that is
over a period.
A long-term equity value fund shows better growth, or a gold fund shows better growth between the two?
Equity will always show better growth over a long period of cycle.
Better than gold.
Better than gold.
So it's always better to invest in equity than gold.
Yeah, I will say 80 into equity, 20 into gold.
But why gold at all? I mean, I'm not
because when equity markets will fall, it will ensure that you have a stable return, because that time gold will do well. It's like insurance.
Yeah, but I mean, if you are not trading, if you are not doing trading in gold,
right,
then I think just investing in a long-term value fund or a fund of funds is better than investing in
gold. Look at that way. If you are not bothered by the market downfalls, then probably you could be in equity. But we do tell that from a diversification perspective, you should be into both.
Have a buy and sell price for a fund.
I mean, then you have to look at each of the portfolio stocks, then you look at buy and sell.
No, there has to be enough, because there are cycles.
NAV, right? There is a net asset value which is quoted on a daily basis. That's the buy and sell price of a fund, right?
I'm not talking about that.
Estimated when researching the stocks, then we will launch.
That is the purpose of having a fund manager.
No, but fund of fund is different. It's a manager selection strategy.
No, sir, it does. Sorry, sir, it doesn't work that way, sir.
It should work.
Fund of fund.
If a fund manager has to do that,
No, sir.
that is the purpose.
We have 30 stocks. There are 10 saying there
Then
are
what
10.
is the difference between a person who doesn't have? No.
See, every fund manager has a different style and different way of looking at markets.
Yeah,
right?
fine,
So what
fine.
I may estimate as a fund manager,
not saying-
he may be estimating
Yes, that is
something
fine. I'm
different.
talking
So
about-
my estimated buy and sell may not work on his.
Yes, for him. I'm talking about your own fund. You as a fund manager, your own this one. What I'm trying to say.
No.
What I am trying
See,
to
the
say.
equity fund of fund was born.
Please listen to me. Let me finish my.
Sure.
There are cycles. You said now it is. There has to be a bad time for value investment. That's what I'm trying to say. So there has to be a buy and sell for that also. That's what
Sir, now he is taking call for, sir, being the fund manager, he is taking a call whether to buy or sell. One minute. Being an investor, you take a call whether to buy or sell.
No. That is why a fund manager.
No. He cannot sell all his funds.
Yes, that is why we are putting our money.
65% he has to invest in equities always.
To see that, yes.
As a regulation, 65% of the money he should always invest. He cannot make it zero.
Different styles of managing, right? And we don't have expertise in each of those styles. We have expertise today in two styles of equity investing: value and ESG, and we have launched those funds directly. But there are other styles which other fund managers may be understanding much better than us, so it's better to play it directly to them and let that fund manager take that call.
That's why I'm talking about your own fund. See,
No, if that was the case, then we would not do a fund of fund, right? We would do a direct fund. Why are we doing a fund of fund is because we believe those fund managers to take that call, right? That is the concept of manager selection, which is very, very popular globally and very, very nascent in India.
So that would mean like, see, you are already covering two styles.
Correct.
Okay. That means say a momentum or arbitrage or other things. You look at other guys. GSEC, you want to put the money in.
Sure.
Is it for that you have other funds, or what the style that is other than what you do? Say
No. It is all equity funds. Equity fund of funds is pure equity funds that we invest into. And those fund managers may have different styles, like for example mid-cap fund, or maybe a growth fund, or maybe a growth at reasonable price fund. So they will have different styles of investing, and we want to look at consistent performers who stay or stick to a particular style, who have a track record built on that style, and risk from process perspective are minimal. So we bank on those managers.
Price matters. So what price you are entering? If you are entering say growth fund at a high valuation.
In our evaluation process, we'll also have a criteria on valuation of those funds.
You will have. Okay.
Yes.
Okay.
Adding to his question, this is the best time to invest in value funds. Is it correct? So at the same time, we are expecting which is the good time to exit. That is to be told by the fund manager. That is what he is asking. If I am not wrong.
Fund also.
Now you are now market has corrected. You are telling this is best time to enter. We are expecting you to tell.
When we look at investors, we think that they are in for the long-term wealth creation, right? And be it good time or bad time, it will keep making money for you given equity markets are growing. So there will be, and the longer you stay invested, we have seen that you have made more money, right? So that's the case for you. Let the fund managers kind of play it out for you. Equity is for investing, right? Yeah, we have seen cash rise to as 30% also in our fund, right? So we have done and taken those calls for you. At the same time, we also recommend that diversify across asset classes and you rebalance your portfolios periodically. So if markets have gone through the roof, you rebalance and move into other assets, and when there is time or markets correct, you move back in. So we always recommend rebalancing as well from a portfolio perspective. We don't say that you put all your money into one thing.
Just one additional. See, now as you know, one of the hedge funds, since you cater to the multinationals, global funds, so why not down the line also have a long short fund? So because there is a lot of things like
we as a group or Quantum, we do track derivatives or understand that, but we don't think that retail investors whom we cater to understand those kind of things. And for what we believe, if the person who is investing doesn't understand that, then they should not invest into that. Also,
but at the same going to for the fund.
We are speaking to investors, making them understand, and then only we are.
That's the purpose of going for a fund manager, fund. Correct?
No, I think we believe that there is no need for an investor from a long-term wealth perspective to be needing those kind of instruments.
No, that's it.
So that is why we as a fund house, as a philosophy, that we will not launch funds which investors find it difficult to understand. Plus, we don't see a need for an investor to invest into those kind of funds.
Investor does not understand even the gold.
All Indians understand gold. If you say Indians don't understand gold, I will not buy into that. Indians have been buying gold through ages. They understand. Even the housewives today understand gold better than anyone of us.
They don't understand because of the investment, this one. They buy it for different reasons.
They are buying at the end, at the back of their mind, it is investment and saving as a purpose.
Saving is different.
Saving put to work. Gold has given 10% CAGR returns over long term. So they have done really well when it comes to saving and instrument better than fixed income.
Sir, in 2004, In 2004, the gold rate was 3,600 rupees per 10
When
grams.
you say long term, is it 10 years? Are you talking about 10 years or 25 years or 30
That's
years?
each individual's definition, sir.
Thank you so much. It's been a very interesting conversation today.
Thank you so much.
Thank you. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.